Today on the CEO Barbecue, we're talking about precious metals royalties together with Summit Royalties. For a bullet point summary of this and all other CEO interviews, please go to resourcetalks.com and subscribe to our free weekly newsletter. The company you're about to hear from has not paid us for the production of this interview, but this interview is still intended only for experienced speculators because this is venture capital and mining is a very risky industry where failure is the norm. All conversations are general and impersonal in nature, and they contain forward-looking statements. I'm not a licensed financial advisor, and my business sells content-producing services, which also makes me biased. So before continuing on, please talk to an independent investment advisor with a good long-term track record because your capital is at risk, and also visit setterplus.ca where you'll find the company's official filings. If you're not 100% sure you understand all the biases and the disclaimers that I just showed you, please go to the last section of this video and do not consume this content unless you fully understand and agree with everything said herein. That all said, Summit only just listed about 2 weeks ago now. It came together through the RTO of Eagle Royalties in early November. It's a brand new company, just founded in 2025 with the focus on building a portfolio of cash flowing royalties, and again, focused on precious metals, so specifically gold and silver to be more specific here. That portfolio currently has more than 40 royalties and streams combined, but of course, not all of it is cash flowing right now. And the cornerstone assets here are just a few, 4 or 5 that we'll talk about. One of them is a 50% stream on Orezone's producing Bomboré gold mine in Burkina Faso. Another one is the 1% NSR they have on West Red Lake's Madsen gold mine in Ontario, which is expected to be in commercial production next year. That'll be a big part of the conversation later on. Third one, that'll be more important next year and is expected to account for about 19% of the revenue, is a half a percent NSR on Zancudo in Colombia that's operated by Denarius. And that's already mining and shipping ore. So some of it should translate into revenue for Summit next year. Yet another one of their big four, if you want to call them, although this one becomes more important than paying in 2027, is actually a stage royalty on the Pitangui gold project in Brazil. It was acquired as part of a larger portfolio acquisition from IM Gold that costed Summit $17.5 million. There are several others, but early stage royalties again in Canada and the US and South America as well, some of which we'll touch upon later on as well. Can they really get the company cash flowing soon enough and protect shareholders from dilution? And can they get the needed deal flow as a small player in a not so empty corner of the mining market to actually grow that NAV? Those are all going to be part of the interrogation later on as well. Summit Royalties is listed as SUM, so that's SUM on the TSXV, where the average 10-day volume is about 200,000 shares. Since listing earlier this month, the stock has been as high as $1.50 and as low as $1.09. With a market cap of just over 91 million Canadian dollars and just over 71 million shares outstanding, today this is $1.28 stock. Now, if you look at the pie chart breaking down the ownership, you're going to recognize 2 names here. One of it is IM Gold at 17% ownership, and then Eagle, which again, that's the company that Summit RTO'd into, and their shareholding is now at 16% of the new co. Management at 15% and institutional investors at 30% leaves an estimated 22% in the hands of retail. What's the relationship with those Eagle shareholders? How much did insiders pay for their shares? And what's the rest of the share structure is something I'll be asking about later on in the conversation as well. And this is where I normally dive into the company's financials, but given that, again, Summit just RTO'd this vehicle, those numbers won't be representative. So instead, I'll be asking Drew about all things money later on in the conversation as well. Now, for this to actually become a conversation, I'm going to have to shut up already. And Drew, I'll give you the word here. But first of all, thank you for sitting down with me today.
Appreciate the time. Good intro there, and look forward to sort of unraveling what we built here in basically the last 6 months.
Pleasure is mine, and I am looking forward to it as well. I don't often get to talk to companies that are that early on in their startup journey. Definitely not in the royalty space. And since this is your first time on the barbecue, we'll still have to go through the smell test first, which again intends to understand more about what the incentives and the track record of management are. But maybe just before that, setting the stage here a little bit, given the state of the market, the royalty market, and the number of players in it, why start a royalty company now?
Well, the short answer is we saw a lot of opportunity to build a business here. And the best way to get exposure to precious metals is through the royalty model. There's no shortage of opportunities despite the competitive dynamics that I think you alluded to early on, and we'll certainly discuss in more detail. Um, but we started out with a management team and a goal right after I left my previous employer, and we went after cash flow out of the gate, and we wanted to build a portfolio of assets as quickly as we could, and we've been quite successful at it. There's no magic sauce here that we're doing that's much different than other. We're just embracing the royalty model that's really had a storied measured return for investors on a risk adjusted basis. There's no better way to get exposure, and we love being a new incumbent in the space.
That's an interesting point where you say that you actually enjoy being, when you enjoy competition, and that's something we'll definitely talk about later on as well. It opens the door nicely to a couple of more things that I want to ask. But again, I'll be starting off with yourself and your track record. Talk to me about that. Who are you, and have you made more money for shareholders than what you've spent during your career so far?
Short answer is yes. And I won't go too far back, but I started my career as a sell side analyst at CIBC. I became a published analyst at the age of 26. I've done a brief stint in investment banking, but I left the sell side more or less about halfway through my 20-year career. I've been on the issuer side more or less since. I think it more suits my entrepreneurial sort of gearing. The first company I went and worked for was a company called Premier Royalty. That's where I got the real royalty bug. That was sold to Sandstorm. I've also worked at a company called Carlisle Goldfields that was taken out by Alamos. Again, a good exit for investors. And then most recently, and probably most relevant to the career and the discussion we're going to have today, I was the first employee hired by Brett Heath at Metalla, where I led the corporate development initiatives there. We did, in the history of the company, they did 32 transactions. I was in the seat for 27 of them. And that's where I really got the institutional following and the knowledge in the space to sort of build what we've built today. So my career has, had a couple different seats. I sit on a couple boards. In the past, and I've done some advisory work for royalty companies or people selling royalties. So I'm either in a royalty chair, actively, looking for deals and promoting, or I'm helping people sell them. I love the space. I'm a self-proclaimed royalty nerd, and that kind of gives me the credibility and the credentials, I think, to run a company for the first time.
Outside of what you just said, Drew, do you do any other companies, any board or executive positions that you have right now?
No, I sit on the board of a small company called Visionary that has a exciting sort of nickel discovery in Wyoming. But it's sort of a sub $10 million market cap company, and I'm there more for capital markets advisory than obviously I don't have a technical background. Yeah. But no, this is my day to day. I work tirelessly at this every day.
What is your day to day? So what does a royalty CEO really do all day? I mean, it's it's easy to envision it, at least for me, with exploration guys who might be just what they do. But what's a day in the life for you look like?
Honestly, it's been a whirlwind of activity. So, and I know we'll talk about the history of the company, but it's everything from getting an OTC QB listing we've got right now. We've just sent an LOI this morning. We're amalgamating the company we just did an RTO with. There is a ton of different things I'm doing every single day. I'd say the part that people focus on and probably see more outward facing in terms of news releases and my presence in the space is looking for royalties and looking for new investors, marketing the company, not just from the perspective of we want, more people to buy the stock and become owners alongside with us, is also looking for deals. So outside of me and my right-hand man, Connor, I mean, we wear a lot of hats. And, we just started this company. So everything from we need to update our presentation right now. The website just got uploaded. There's a couple of things we got to do on it. I probably have a to-do list that I try to get shorter every day, but it grows immense all the time. I was out here in my office until 10:30 last night. I was up early with the dog on a call. So it's 24/7. I'd suggest 2025 is probably been the hardest I've ever worked in my career. And it's been really rewarding.
What kind of dog are we talking about here?
He's a golden retriever mixed with an Aussie Shepherd named Bernie. He may actually speak up at some point. He's quite vocal, but he's my shadow. So he's always with me.
Golden Aussie. That does sound like a bit of a ball of energy, if you will.
Correct.
Drew, insider ownership is noted as 15%. How much of that is you personally? What's the average cost that you've paid for those shares?
So as a founder of the company, I wrote a check in for close to 20 grand to start the business. I forego a salary of about a year. So my average cost would probably be, closer to a penny than most of our shareholders. I've also written checks when I've been able to. We wrote money at 90 cents, my family and I. But majority of my ownership comes from being a founder in the business, along with some of the directors have some shares as well. Every director on my board has written a check at 90 cents, along with all of our new shareholders as well, including myself. So we're very well aligned on that side.
Do you plan to be in the open market supporting the stock on the bid, as well as providing money in financings, or how does that work for you? I mean, and again, with your personal financial situation, I suppose.
If I had more money, I would certainly be buying more, and I do plan on buying some in the open market in the near future. But as a guy early in his career that hasn't had that huge windfall, I don't have the means that other CEOs have. But from a foregoing revenue, from a salary perspective, from a putting everything on the line from this, I am 100% all in and aligned. All I care about is making the share price go higher. That's very important to me, and it's very important also to sort of my career trajectory. I think I got to do right and continue to make people money in the stock.
And that's really what I'm trying to understand here is how important is the financial commitment? And I understand there's other stuff. There's career risk and image risk and everything else that you're taking and you're putting on the line here. But financially, how important is the investment to you? If you can talk to me in percentages, do. And but yeah, that's what I'm trying to understand here.
Oh, my stake in Summit represents well over 90% of my net worth. I own a house. I have a personal a PA that I invest in other mining stocks in, but I'm all in on this. And from a personal net worth standpoint, I don't have a trust fund. I have a real mortgage, and I don't drive a fancy car. So this is 100% what I care about. And it's important to me and my family, my wife and kids.
What kind of car are we talking about here?
I drive a Volkswagen. My wife drives a Mazda. But if I'm going to brag, it is the most expensive Mazda they make. So, I don't want to show off too much, but.
I thought that 90% of your net worth would be the healthcare they have to pay for your dog, given that you're in Canada. But now that I'm thinking about it, I don't even know if you do have private healthcare for pets.
When he gets hurt, we go to the vet, and it's never a fun conversation. It's actually not the dog that's the issue. It's the cat that's getting hurt more than the dog. So.
Cat and a dog, a fun time,
and a hamster if we're going to go down the furry friends that we have in the family here. So
yeah. Well, now I understand why you want to stay in the office till 10:30. I probably would as well.
Yeah.
Talking about alignment, I also want to know what drives Summit as a team operationally, Drew. So talk to me about the KPIs here, or targets that determine insider compensation. It'll be cash or options and shares or whatever else you might have.
Well, so the formal contracts actually aren't in place until next year, and that's actually something we're working on. The first employee we hired was on June 1st. That's Connor. We have a part-time CFO. So we have great governance. We have a really good team, and I'm sure we'll talk about that in some respects. But we are building kind of on the fly here a little bit. We are like the website was up and running on the Thursday. We ratified the board on the Friday. We started trading on the Monday. I mean, this has been a sprint. Everything's been done extremely well. I've been very proud of what we've accomplished. But in terms of the KPIs, I mean, we are all well motivated by the stock. So I guess, and I'm reading into your question here, we don't pay board fees to our directors. They have all written checks into the deal. All of them are fully motivated by the share price going higher, including myself and including others. The alignment is fantastic. Our chairman has written well over $1 million US into the deal himself, along with some of the other directors. So we are all very excited to get this thing out and get a proper multiple.
Mm-hmm. Yeah, that's what I am asking about is how do you measure success? What is success? NAV per share? Is success cash flow per share, or is it just share price? What would you base that on?
I guess ultimately share price is the right answer. But I would suggest my tenure in the royalty space has been pretty long. There are times when you're out of favor, and what you can't control is the sentiment in the market. You can't control what the gold price is doing, but you can control that you're doing accretive deals. So I would argue doing accretive transactions should translate to share price performance, but as sentiment and changes in the market changes, that you can't control that. And just speaking to the portfolio that we've built ourselves, it has performed very well. And I think that speaks to the quality of the management and our execution so far. But ultimately, share price is all that matters to me. It's all that matters to our shareholders. They're here to make money. But in terms of running the business, we want to make sure that we have good, competent people in the seats. We have excellent governance already, and we're going to continue to roll that out as well. And we also want to manage how much of our portfolio is operating, how much of it is on the come, jurisdictional risk, stuff of that nature. There's so many things to consider that we talk about internally. But I think, ultimately people buy shares to make money, not to feel good that, their things are being run on a sort of straight and narrow. I mean, I think they clearly are, but anyway, rambling on here a little.
Within junior mining, I'm sure there's at least a percentage of people who buy stock just to kind of scratch that gambling itch, which fair game there too. But this might be a good segue actually to move on and talk business strategy here, Drew, and essentially ask you about how do you plan on increasing that share price there? What do you want to build? Do you want to build a cash flow generator? Are you looking to build something that is going to be a takeover target? What are you really working for?
So both. Short answer, we have built a cash flow generator. And this is a takeover target. Quite bluntly, the machinations of the consolidation in the royalty space are just rampant right now. It's never been a more interesting time to be in the royalty space. It's been very boring. It's been very, yawn-inducing at times. We're cash flow positive today. Our G&A is extremely low. Can't stress that enough. We have cash flow coming in from Madsen. We have cash flow coming in from Bomboré. We're about to get our first check out of Zancudo. And what's really important here is all these assets, we're cash flow positive today. These assets are going into throughput expansion. They're drilling actively. We plan on keeping that cash flow positivity going forward. And I think it's an important sort of philosophy of the company. And when we founded this, one of the reasons we immediately targeted cash flow was this should be a self-sufficient business. In the royalty space, we like to pride ourselves on it being a superior business model, which it objectively is, but you need to be able to not be diluting shareholders to pay for, trips to Europe to go to conference or for bonuses or for listing costs. We need to do that on our own.
When you say when you say cash flow, you're talking about, covering your G&A and everything with the money that you have coming in right now, or?
Correct.
Okay. Interesting. And we will get to that, specifically talking about some of the assets that you have. And again, I don't get to grill royalty companies as much as I do Explorica. So what do you think is the biggest challenge for you as a royalty startup, trying to go to that point where you're growing cash flow more and more?
And this sounds very arrogant, but I believe it. Getting started is the hardest part. Getting started, getting a couple cash flowing royalties, getting a group to back you and believe in you as a private company was more challenging than most people appreciate. And now that we have the listing and we've got the cash flow coming in the door, it's certainly been easier for us to raise capital and get that critical mass. There's a lot of growth left in this business. We are actively trying to grow the portfolio every day, but the hardest part is getting started. I'll tell you that because this has been a very long and rewarding yet challenging year for me. And then doing things on an accretive basis or doing things on a strategic basis to grow the business in a meaningful way that'll actually create shareholder value is probably the next challenge if you really think about it that way.
Mm-hmm. I do want to touch upon some of the other kind of main things like your financing challenges and whatnot, but this also might be a good point to talk to me a little bit about that year of yours that you've had here. Let's start at Metalla. What did you leave in the first place? What happened there and what happened after that?
Look, I remain a shareholder at Metalla, remain friends with everyone there. I was pretty ambitious and wanted to keep growing the company and growing my profile within it. And quite frankly, I don't think that door was going to open for me. And I left at the end of March and immediately started this company. I still remain friends with the company. And like I said, I'm still a shareholder. I'm very proud of what I did there. But I think it's the best thing that's ever happened to me from a career perspective. It's time for you to go out on your own and do your own thing was more or less the conversation with the CEO. And, 3 weeks after my departure, we went fishing together. So there's no bad blood there. It's time to, time to get traded, I guess, or, go to free agency, I guess is probably another way to use a sports analogy. I'm not calling myself Mitch Marner or LeBron James or anything along those lines, but, it's certainly, there wasn't a spot for me there from a growth perspective. And I've really embraced this challenge and I love it. And hey, look, I've already made guys money and I plan on making them more.
Well, talk to me then about the history since then and how you started building this company. Because sort of a question that I have with Explorcos when I hear about a new project that they're always very excited about and whatnot. My first thought is like, if it's as good as you believe it is, why was it on the market in the first place? Why were you able to get your hands on it? So I suppose same question for you and your IAMGOLD deal and the other deals that you've done since.
Okay, let's get into it. So we started this company April of 2024, but there was absolutely no deals in it. I wrote a majority of the check. We seeded the company. I bought the computer I'm using today, and we went out and we started looking for a deal. Immediately, we created a website. Sorry, we created a business and with my lawyers. And we had originally actually had a deal that fell through on legal due diligence and a small operating one. And the goal always was to have that operating asset as a means to go and scale into a portfolio. We had our eye on the IAMGOLD portfolio. So that kind of came to a fruition in November of last year, basically a year ago today, that we signed the LOI with them. And that's an important sort of timeline that we'll explore a little bit later on. The reason why IAMGOLD was available, and this is my belief, and I've talked to other royalty companies, I think the number one reason that the IAMGOLD portfolio was available to us was the original portfolio we bid on had 15 assets in it. We ended up closing on 9. A lot of the assets within that portfolio had a right of first refusal. When you think about the bandwidth of I'm just going to name a random company, I don't know, like a Royal Gold or a Triple Flag or any of these guys, they want certainty that they can acquire it. And to go through all the technical due diligence and work with the company and then have those assets disappear kind of made it less transactable. This is my belief. Certainly, I don't know this for fact. So I think that's probably the first impact was we were willing to work with IAMGOLD and work with the right of first refusals and work through them because we thought the resulting, even the stuff that couldn't be ROFR'd out did have real economic merit. The other side of it was, and I can't speak for Renaud and the team at IAMGOLD, and I didn't deal directly with him on most of this, was we came to them with a proposition that was, yes, we'll give you cash, but we're going to raise stock at a discount, not at 1 times NAV that everyone marks their royalties at. We're going to raise stock at a discount. It was around 0.6 at the time. And that's going to enable us to fund the business, fund the cash payment to you, but also give you a lift and give you that sort of value that, that number they had in their head, which we were a little bit later on. I'm happy to report we've now, through their shareholdings and everything, probably delivered more than they expect already, and I think there's more to come. So I think that's how we got the IAMGOLD deal done. By an extension of the Madsen transaction, through our investment bankers, we got word that there was a process potentially starting or a teaser going out from the spot company, and based on my track record and a relationship there, I called them up and said, what are you guys looking for on this? And we preempted that process and did another bilateral deal with them. And we're glad we did because before closing on the Madsen portfolio, we were going to be break even on a cash flow basis. Now we're cash flow positive. And I think that's a really important thing to come out of the gate with and say, look, we've got revenue growth, and we're a self-sustaining business right off the hop. Just as an extension of this, the third deal we did of consequence, and certainly very consequential, was the Eagle Royalties deal. We were in discussion with Tim for a while. He certainly had other people calling him, but he and I really get along well from an ethical standpoint, from the way we view the business, and we put a premium and a plan in front of them that was quite enticing, I believe. And they're still shareholders in the business. So how we got these done, I mean, there's a different story every time, but it's grit, hard work, networking, and I guess listening to what guys, really care about at the end of the day. And that's going to help us, compete going forward.
Well, you're mentioning a couple of times here that you're trading on a discount to NAV relative to your peers. How come? What is the what's the market not seeing or appreciating, and how do you fix it?
Well, we've been trading for 2 weeks, so I'm asking investors to be patient. We are up 40 cents, so call that close to 50% since we started trading. So I'm not suggesting we shouldn't be. We're not patting ourselves on the back, but I don't think that's a bad starting point. But there's three things that have happened. The first is all of our peers have doubled since we had the initial conversation with IAMGOLD a year ago. Gold's up 60%, silver's up 70+%. So there's a bit of a catch-up trade there that we have to roll out for sure. And we've also got to educate the market. A lot of people haven't heard about Summit, and that's why I'm doing interviews with guys like you to get the word out, because we will bridge that gap. And royalty companies typically don't trade at a discount for a long time. So I'm really pounding the table there and getting out there wherever I can.
Is it only marketing, though, that is going to be your solution to the valuation problem, or is that only part of the solution?
I think it's part of the problem. Sorry, part of the solution for sure.
It can be
If,
part
if
of
I
the
knew
problem,
if
though.
I
You're
knew
right there.
exactly how to close the gap, it would have happened already. I think awareness marketing is key. Just as a starting point, we've also had a small amount of selling, and again, I'm speculating, but I believe it to be true. We did have some of the selling out of the royalty vehicle that did create a bit of churn. I'm happy to sort of report that we took that selling in stride, and I was able to get a lot of our institutions to buy into the market. But yeah, I mean, it's a combination of all those things, and it's not just me marketing the company. We've got Connor, who's done some marketing on his own as well. So we've got to get out there, and the solution isn't just to market your way to a higher multiple. We also need to demonstrate and communicate that effectively whenever we get an opportunity to.
What about the Eagle shareholders there? You're noting them at 16%. You believe that's still the case? And what I'm really asking for here is that typically when you do an RTO deal, the shareholders from before that, they bought a different company, right? That they end up owning. So they don't necessarily want to own what you have to offer unless you actually convince them to. So what's the case for you? What's the relationship with those legacy shareholders?
So the best thing and the worst thing about Eagle is it has 3,000 retail shareholders in it. Not one of them owned sort of more than 0.5%, except for some of the guys we locked up like Eagle Plains. The good part about that is we do get that churn, and I actually really embrace it, although it's caused a little bit of stomach ache at the beginning, because I think if you look at a lot of the royalty businesses that have started, and I'll name names, but these are all friends of mine, Triple Flag, Mavericks, even Elemental in the early days, the liquidity wasn't there because they were able to create the business by issuing shares to large companies for portfolios or get institutions that typically don't trade a lot. So we want that churn. We want that liquidity right away. The one thing I will add, though, is yes, it's a different business. And yes, they got a 50% premium. So just to take a step back, they were trading at 12 cents. We let the Eagle vehicle buy us at 18 cents. So there's a premium right there. To put it in today's terms of our share price, because there was a rollback, they were trading at 60 cents and we let them issue us paper at 90. So that premium was right there. The liquidity in the Eagle vehicle was also fairly light. So I would also imagine some of these guys are going, I've held this for a while. The liquidity's here. It may dry up. Now's the time to get out. I don't know for a fact what's driving some of the selling, but from a business standpoint, we still have their portfolio of royalties. We are still a royalty company, and we've introduced, I'd say, a much more experienced management team, particularly in the capital markets and the royalty side. We've also introduced a portfolio of cash flowing royalties that have a lot of accretion ahead of them. So I can tell you why I think they should hold, but I also can't tell you why people are selling. And my job, straight up, there's CEOs that get very fixated on selling. I want people to make money. People have divorces, roofs collapse, pets get sick. Your job is just to find more buyers. At the end of the day, you can't focus on why people are selling. Maybe if it's one of our strategics in there, I might take it to heart and want to listen a little bit. But at the end of the day, it's all about just maintaining the foot on the gas.
Was the warrants and option situation for you, and yeah, what part of that is legacy? What does that look like?
So we have issued 0 warrants as a management team. There are about 1 million warrants from the Eagle side that are at 250. So that's roughly a double from here. They expire on May 18th next year.
Okay.
We issued roughly just over 3 million options at a premium to what we are coming out at 90 cents at $1 to existing boards and board members and some of the management team. And then there are some options from the Eagle side that are roughly at $1.50. Those are all held by insiders. Those expire in May as well. So from a dilutive security standpoint, the short answer is there's really nothing of consequence here. I know some Explorcos have to issue warrants. It's part of the capital structure. I am a firm believer that I will never issue a warrant, or I'd like to never issue a warrant. Never say never. But I think the quality of investor, when you don't give a free trading share and give a warrant, it really sort of filters things through a little bit more cleanly. It's worth pointing out, actually, everyone's shares are free trading except for my shares, which are in a 2-year lockup, and then the management and directors that are also in a 2-year lockup, voluntarily locked up for 2 years. But everyone that wrote me a check into the IAMGOLD transaction in Madsen is free trading. So there are no real restrictions. There's not a wave of shares coming, in 6 months or 4 months that you typically see with these things. I'm not suggesting don't do your investigation, but there's not a lot of things you can dig into here from a capital structure perspective. We've really designed this cleanly and with purpose.
Yeah. Yeah, well, the only thing that I could find there is those founder shares, which in your case, they're actually founder shares. So it's not like someone founded the shell and got a bunch of, millionth of a penny shares. And yes, your shares are cheap. We did talk about that. But then you also mentioned all the rest. So that's a good point that you're making there. Also where I was going with the warrants question. And by the way, yeah, good that you don't want to issue warrants. I hope that's true. We've got it on video now. So now you're extra motivated. If you do issue warrants, I'm going to call you up and I'll be like, Drew, what the heck? What happened?
Yeah.
But no, I was thinking about raising capital. I mean, I was going to ask you, is raising capital going to be a challenge? You said no warrants, which makes me think that you're confident in your abilities to raise capital.
Yeah. Well, look, maybe someone's watching this when it comes out and they're thinking this guy's arrogant that he thinks he can raise money. We think we can raise money. In fact, since we closed the IAMGOLD transaction at the end of May, we've bid close to a little over 200 million US on transactions. Some of them have gone to some of our competitors. We've done that with a combination of debt and, quite frankly, our confidence in our ability to go raise money. If you look at our institutions, they're quite strong. If you look at our chairman, specifically our chairman, Gerald Annette, he ran Scotia Mining Sales for almost a decade. He then went and worked with Richard Wark, sold one of their businesses, and took Capstone from 60 cents to $10. His institutional Rolodex is incredible. And then other members of the board and myself, we've got a really good Rolodex. And I'm not suggesting it's a slam dunk. We can get guys to write checks, but we don't. One of the things that we struggle with a little bit is people look at us and think, you're just under $100 million market cap. I like that it's cash flow. I like that it's a little story about how you're going to compete. We can compete and we can raise capital.
Yeah, being able to raise capital and trusting your abilities to do so, I think, is important as well. Would you only raise capital though for deals, or would you sometimes just raise capital so that you have money ready when a deal comes along? As in, would you only raise it when you know you have a deal, or would you also raise kind of, beforehand? So
speculation here. I don't want to suggest we won't raise money if there's not a deal. The one thing and I think I'm going back to my corporate development days, say you have two hands, one hand, you got a harpoon and you're going after the big whales. Like we've bid more than our market cap 3 times. That's the harpoon. And then there's the BB gun where, it's a $2 to $5 million deal. I would hate to have to go to the market for a bunch of smaller deals. So I think it's good to have a smaller sort of balance of capital available to for some of the smaller transactions. But right now we're sitting well over 3 million US. We've got a receivable for over 3 million US, and we're cash flow positive. It will not enable us to take a big swing. But we also don't want to have to go to the market every time we want to, hit a single. So I don't know if I'm answering your question directly, but I think what, you can take solace in is that we can't do anything big without going to market, clearly based on our capabilities. But we would like to make sure we have a healthy enough balance sheet that we can also execute on things quickly. One of the conversations we've had with some of the larger transactions we've looked at is how much capital do you have available and how much do you need to go raise in the market? Having a debt facility in place can certainly say we can get that capital quickly. But I think if we have, let's just pick a number, 10 million, to 15 million on our balance sheet and say we have to do 25 million, it's a much easier conversation when we're competing with other people to have that on the balance sheet. Yeah. So it's not just, nice to have, it's also an aspect of you're competing against much bigger, deeper pocketed investors. Some of the larger royalty companies, I'm not suggesting they're in every conversation where they're cash flowing $1 billion a year. So their money is real good. And then there's a bit of a question mark, can you go and raise that money? We've demonstrated that we can, but until we actually go out and do a big public financing for, 25, 50 million bucks, people will still, there's some deal uncertainty in there.
Do you think there's other ways, like an ATM or something that you could put in place, or would you be against that?
I'm not a huge ATM fan. Would probably be my gut feel on that. The one part of the ATM that I don't think is celebrated, and we had this at my previous employer, is the ATM is a very good mechanism for when you meet an investor that, quite frankly, doesn't trade in the open market. They like to buy deals, and you're like, there's no deals coming, but I want to give you $5 million. The ATM is a very good mechanism for that. But I think whenever there's strength in the stock, you don't want to think that we're selling into it. Whenever there's strength in the same sort of light, they act like a warrant, a cliff of warrants. This thing goes there, if this thing goes up 80%, they're just going to sell into the ATM. But I also think it's a good idea to have one in place. It really depends on how much you use it. And we've had some discussions like, should we do a short form shelf or something to that effect, and just put all those in place. You don't have to use them. They do cost money to set up, but the ATM is not a financing mechanism that I would like to implement. And if I do, it would be very sparingly.
Well, how many deals would you target a year? Is that a thing that you even think about, where you're like, oh, we want to do at least 2 deals a year or something like that? Or is it more bottom up and see as you go type of thing? Really what I'm trying to get at here with all these questions, by the way, Drew, is when are you going to have to raise capital again?
I would be shocked if we don't do something in 2026. How's that? Just to give you a sense of where we're at. The one thing that and this kind of will leak into the conversation about how you're going to compete, though, is with this slightly lower, not slightly, quite a bit lower valuation than our peers. People are quite interested in taking shares back as consideration for the royalties. So there's an opportunity to stack on some growth without actively going to the market. And when you go to the market, look, dilution is dilution at the end of the day. If you're issuing it for royalties or you're issuing it for cash to paper royalties, it's functionally a similar exercise. There are costs, legal and banking costs that come with it. But there is an opportunity for us to scale up without actually going to the market right away. And we're happy to think strategically with this discounted share valuation, because it's not going to last forever.
What are those opportunities to, because essentially everybody's always looking for non-dilutive growth, right? So what are those opportunities like for you?
Well, non-dilutive growth implies issuing debt, which we have the capacity to do. The opportunities I think we're referring to, let's go back. Let's just say we find another iron gold portfolio. It's actually easier if I talk about that hypothetically, because it's gone. If we find another iron gold portfolio with a company that's got a strong balance sheet, it's more a bit of an afterthought. Like the royalty portfolio in iron gold, no one knows they have it. It's well, I mean, us royalty nerds do, but for the most part, no one knows they have it. Thinking about a way to scale up the business through issuing capital is well documented. And the easiest example I can give that is Mavericks. Mavericks started out in 2016. They did one treasury offering at the start. They then proceeded to do a deal with Newmont, Goldfields, two with Newmont actually for two different portfolios. One came from Goldcorp and Kinross. And as they expanded the cash flow generation in their portfolio, as they increased the scale as a market cap, it's in every single royalty company's decks. As you get bigger, your multiple goes up. So that facilitation of multiple expansion is afforded to anyone that would do a deal with Summit. And based on our size, based on our clean capital structure, and based on our valuation, we think we're the best home for it. And this isn't just a thesis so far as that we're hoping to implement down the road. Some of these guys have actually called us, like billion dollar companies are actually calling us and talking to us about this. So that's a big sort of competitive advantage I think we have right now. We're small and we're cheap.
I also wonder how much of that is needed to make that business strategy work. And so maybe we can talk about whether you want to grow kind of very selectively and slow and steady, or would you be kind of looking at growth at all costs? Like, what would you see yourself doing 10 deals within a year, or would you think it's more like 1 to 3 type of deals?
I don't have an ideal number, and let's go with 1 to 3. And it is not growth at all costs. We look at things on a per share metric. We also there's two schools of thought. There's scale up immediately because size matters, which I think is well documented in some of the aforementioned sort of curve of size and multiple that I discussed. But there's also an element of our portfolio. A lot of our assets are early stage. A lot of them have throughput expansion. And look, a lot of these companies that you're going to talk to or say there's lots of resource upside. There's tremendous on these. When you buy royalties in the first or second inning, like we have, the ability for them to expand the mine is very high. We also have a growth asset in relation to Banyan, which I believe you went and visited, that we're extremely excited about. And we think that value will appreciate in time. So there is a conversation you have to have as a management team is what happens if we do nothing and we continue to keep our G&A low and just wait for these things to turn online. There is a scenario where nothing happens and this is a better business in a year than it is right now. And I think you have to acknowledge that. But our gearing, our personalities, our mandate is to grow this business, and that's what we're actually trying to do. And look what we did in 6 months. We went from 0 to 47 royalties. We went from an idea to cash flow positive. Like I can't guarantee we're going to do that in the next 6 months, but that's sort of the cadence that we operate at.
That's the size does matter for sure. And I generally operate under the framework that nothing ever happens. But jokes aside, size does matter in this space. That's why I ask you, is it growth at all costs? Like, do you see it as part of your business model that you have to grow as fast as possible so that you can become more relevant in terms of competition? This is where we can talk about competition. How is the competition in this range of the market, and how do you compete as a newcomer?
So it's always been competitive. At Premier Royalty, you can't compete. We scaled up the business, ended up going to Sandstorm. At Metalla, how are you going to compete? We did that as well. I think there's with the pricing and the gold price, and the opening of equity markets and the balance sheets of a lot of producers, there's this common belief that there's no product out there and it's going to be very expensive. It is very expensive. It always will be. So how we're going to compete is, and I know the corny answer is we're going to outwork everyone, but I do believe we can. But our network is fantastic. Each one of my directors is like a mini corp dev guy. They're shareholders in the business and they're showing us deals. We've already done deals on a bilateral basis. So I will not sit here and suggest it's easy, but I will suggest that we're very good at it. So again, coming off as a little arrogant, but I think you have to be to try and compete with a lot of the royalty companies. Going to your second question, how competitive is the dynamic? How are things changing? There's always, the way I look at the royalty space is there has always been the big three. So you got Franco, Royal Gold, and Wheaton Precious. And then you've got sort of the middle three, or I guess now the middle two, because we lost one with Sandstorm. And then there's everything under $1 billion that we occupy. And there's a lot of noise around Tether and some of the other M&A that's happened in there. We think we have the ability to really pick off sort of stuff in the 5 to 50 range. Because the scale matters narrative is not something that I believe in solely. It's also held by other management teams, and they're trying to scale up at the same time. We think there's an opportunity for us to pick off some of these smaller royalties, one off where we can, and then really swing for the fences and go after one of these big ones. But from a competitive standpoint, cost of capital, we're going to lose that battle every time. If someone's trying to sell something for cash, call Franco, call Wheaton. It's that cost of capital game. We can't play it. We can get creative in structure. We can get creative in terms of presenting people with a real tried and tested method of this re-rate that has been well documented through my previous employer, through Mavericks, which obviously got taken up by Triple Flag. It's been documented through Elemental with they did a deal with South 32 early in their days and did really well by it. So it's not a thesis that's grasping at straws. It's one that's worked in the past and gets a lot of traction.
Is cost of capital the main thing for royalties, though, that determines the fate of a royalty? Or what do you think that the fate of a royalty company really depends on the most?
That's a really big question. So let's just pick a random example. And again, I don't have any speculation on this, but the Kansanshi deal that was done by Royal Gold, they got $1 billion from Royal Gold. Those kind of transactions, I think cost of capital drives the participation and who's in and who's out more than anything. You're also talking about $1 billion. And then the nuances around what kind of structure you put in place. You're seeing people get more creative with the structure. But I think on the larger side, we're talking about $1 billion of capital for a gold stream. Cost of capital really drives the bus. And then there's the smaller acquisition financing. There's things that are come out of M&A that are generated. What is the owner of that looking for? Are they looking for they want it off their books? They want to put it in a team to take custody of it and hopefully grow that and diversify it. There's a lot of different sort of mechanisms as to what people want when they do these deals. But cost of capital on the large side is 100% the end of the game. I would suggest. Mm-hmm. We're not writing streams for builders in on First Quantum mines anytime soon.
And it's also like a lot of the projects out there that would be looking to sell royalty wouldn't fit into a Franco, right? They might be too small. And I'd have a question for Franco as well. How do you keep growing from there on out? Like the situation that they're in, that's also a challenge, right? What kind of projects would you be looking for?
Well, look, we and I know it's a terrible answer, but we look at everything within sort of our suite of metals and risk profile. Ideally, we have a producing or soon to be producing mine. And the way I look at the growth side of things there's the long dated options where the management team put out a PEA, they need to raise 20 times the market cap to build it. There's no start date, there's no permits. That optionality has a place in your portfolio, but that's not being valued at the rate that it used to, at least in my career. And then there's the more certain development timelines. I'll pick one from our portfolio, for example. Jaguar's been operating in Brazil for 20 years. They have the cash flow. They have a mill that's nearby. They openly said we are starting development next year. That's the kind of development that we'd love to get into. We'd love to find another Pittingi. We'd love to find another silver stream on a major gold project as well. If we could find twins of stuff in our portfolio, that'd be fantastic. But ideally, we're looking for gold and silver exposure at a good price. And we're not the only ones.
What about, because you said risk profile, I suppose jurisdiction is part of that, or are you more agnostic to jurisdiction? We
will look at pretty much any jurisdiction. I mean, there's some that are just no-goes, and I don't want to name any sort of nations but I think you could probably come up with a short answer. Where I've struggled in my career, and I think my management, my board and Connor agrees with this, is we're finding the prices for less favorable jurisdictions don't have the discount that we would sort of perceive. You're looking at something in a part of the world that is a tier 2 jurisdiction, let's leave it at that, and they're asking for 1 times their net asset value. They're asking for single digit IRRs. So I haven't really done much in let's call them tier two jurisdictions as a result of that. I love the idea of we just bought a royalty at a discount that's a high grade gold mine in Ontario. Um, so why would I go to a far flung region where our institutional and legal and quite frankly transactional knowledge isn't there? So I'm not saying we'll never do a deal in a different jurisdiction, but it's certainly one that the money has to be there. If you see me stepping out into a jurisdiction that's not well known, or if you see me stepping into a metal that doesn't seem to be a key focus, it's probably a very good deal. And quite frankly, when guys come up to me, I'm like, this isn't our core focus. The rate of return has to be pretty aggressive, and they go, okay, great, don't bid. So,
well, Burkina Faso is pretty far flung, and I do want to talk about that. So we'll hopefully get to it here in a couple of minutes. I know you don't have all day, by the way, but would you prefer buying royalties one by one, or would you be looking for a portfolio as a whole? Again, similarly to what you did with IM Gold, or was that kind of just to kick off the company?
we'd love to buy another portfolio. We're not afraid to buy one-off royalties like we do with Madsen. But let's unpack. You talked about Burkina Faso earlier. For what we paid for that royalty, I would do that deal every day of the week and twice on Sunday. I'd also like to sort of highlight the fact that it's not near the Sahel where a lot of the regions are. Don't pretend to be an expert on Burkina Faso, but they've got a long history with no security concerns there. And they've executed flawlessly as an entity there. But a development asset in Mali would probably be one where it would be 10 cents on the dollar. And I think that kind of plays into sort of the way we view things. And quite frankly, I've never done a deal in Mali, and I said earlier I don't want to pick out a certain nation, but it's in the news right now, and Barrick just settled, and there's been some ruminations of tougher jurisdiction to operate in. Let's just leave it at that. This isn't my personal opinion, but it's certainly one that at least the general public shares.
Mm-hmm. Yeah. I do want to talk about the assets maybe sort of one by one. I did want to start with Madsen, though, which is pretty much half the company at this point, as far as I understand it. 50% of your
half the revenue.
What's that?
Half the revenue. Worth pointing out, and we haven't talked about royalties specifically. There's an asset here that makes up more than 20% of our net asset value. So it's already fairly diversified, particularly for something at this stage. But half of our revenue next year will probably come more or less from Madsen. But it's an important part of our portfolio for sure. I'm not trying to hide behind that.
I find NAV a tough concept in early stage royalties. That's why I try to flock to cash flow and revenue and look at those two things. 1,500 ounces of gold equivalent. That's what you're expecting for 2026, as far as I understand it, though.
Let's call it 1 to 1.5. We haven't put out formal guidance. That's certainly we will be cash flow positive on the back of it. But I do want to quickly sort of touch on that NAV conversation, because our shares were so attractively valued. We've more or less, in all of our NAV estimates, just run the reserve or mine plan that's been publicly disclosed by the operator, times the consensus gold price, times our economic interest under contract. I'm not here to flog the rest of the royalty industry, but as these things trade at a premium, you see a little bit of a stretch. They start converting M&I, they start converting inferred resources, they start having some very rosy start dates. So I'm very comfortable with our NAV profile, especially some of the, before we went public under NDA with some of the institutions that have invested in this. I think it's worth pointing out that the quality of that NAV is high based on the inputs into our model. But more specifically, and this is something that I think is an important focal point of us, is a lot of our NAV is either in operation or has committed timelines to production. And that is easy to understand. West Red Lake says they're going to do about this many ounces next year, times 1%, times pick your gold price. Like, it's very easy for people to follow along. And we like that it's simple and easy to understand. So our NAV is higher quality. I can completely appreciate your hesitance on NAV. I think as mining investors, you should be skeptical, particularly when it's an operating mine. A guy like me that's analyzed a lot of them will pick apart, operating cost per ton and underground mining methods and recoveries. It's a little bit cleaner in the royalty space, but it can be gamed, I suppose, is probably the fairest way to put it. I'm not surprised to see you have that viewpoint at all.
And then there's jurisdiction and everything else in the meantime, team and everything else that's just impossible to account for in fixed metrics like NAV. But it's close to the best we have, I suppose. Madsen, though, you say it's easy to understand how it works for you. Madsen's not an easy project in and of itself, though, if we were to judge it based on its previous operators with pure gold and whatever happened there. And West Red Lake is targeting commercial production in what they call early 2026 with ramp up throughout the year. What gives you the confidence that this time will be different?
The short answer is the amount of definition drilling they're doing and the different approach they had on the mining method. But I love this question because I actually went through a similar experience when this was first brought to our attention. Look, this thing had a very large blow up in the past. The biggest thing that gave us comfort was they went out and did a bulk sample in all the zones based on their definition drilling, and it came back, plus minus 5%. The area of the old operation, and this is my personal opinion, this isn't, I want to preface this is, I'm not speaking for West Red Lake, was the McVeigh zone where they had some variability before. They're basically focusing very strongly on the Austin and South Austin zone where they've had a lot of high grade gold. It is not an easy ore body. I'm sure, Gwen Preston or any of the other people that you speak to from the company will tell you that. But at the same time, the grade is there. It's in Ontario. It's got an operating mill. It's worth the effort, I think is one of the lines they use there. And we're very confident as a royalty holder. They're already making money. We're very confident as a royalty holder that we'll get very much an economic return on that asset. And yeah, I don't know if I've answered your question, but I think it's a properly capitalized. It's a different mining method. They've done a lot of definition drilling. They went from 20 meters to 7-meter centers, which is much more common in Red Lake. And let's be honest, gold's at almost 6,000 Canadian. I'm not suggesting you should make an investment based on the fact that prices are high and everything works. But prices are high and more things will work in this environment. And I think that gives them more wiggle room out of the gate.
Ideally, you want them to work in more conservative environments as well. So that's really where I'm coming from. And maybe we can talk about that. What are the assumptions or what's the production profile and recoveries that you're assuming for Madsen in order for it to get you that, 500 to 750 ounces?
Well, the recovery rate's simple. This thing's been producing before and the recovery rates have been right around 95%. I'm not going to suggest that can't go up or down, but 95 historical production, the metallurgy's never been an issue. If you look at how we structured the deal when we bought it, we put a contingent payment on 60,000 ounces on an annualized basis for 3 consecutive quarters, or 150,000 ounces. We were taking the view that the mine plan that called for 65,000 ounces may not get hit right away, and we structured that accordingly. I think this thing will comfortably do 45, 50,000 ounces next year. This is our view. This is not guidance. We do not have any insider knowledge from them. But what gets us excited about this asset, and I guess by extension other assets within the portfolio, is they're currently operating around 650 tons per day. The mill's rated for 800. With the permit, they can go to 1100. All of the milling equipment is suited for that. And we've actually seen technical reports in the past, or stretched technical reports in the past, calling for 1500 tons per day. We think once they stabilize operations, once they get the shaft going, as they continue to execute the way they have, there's a chance for this to go from 50 to 80,000 ounces. We're not paying for that today in our model. There's also a satellite deposit called Rowan that's not part of our royalty, but it's part of a larger complex where they're openly talking about going to 100,000 ounces. I think there's upside in Madsen, specifically with the drill bit. They've hit some spectacular drill holes as of late. And, we're really confident in this team and their ability to execute.
Something else that I've been wondering, and it is to the point that you're making here, but something else that I've been wondering about royalties in a very bullish price environment is, could it be too bullish? Could it push the operators to try and buy back their royalty or cut some kind of a deal that takes away that cash flowing asset for you? What's the contract there? What is the royalty buyable? What does that look like?
So we're always competing with operators when we buy royalties on a third-party basis. We were very careful not to talk to West Red Lake and let them know that we were buying it back. But once a royalty, and this is jurisdictionally, I don't want to get too nerdy on the legal side here. every jurisdiction is different. But for the most part, once a royalty is in place, it's affixed to the property. It's there forever. You may find an environment where people try to buy it back, and look, we would evaluate that all at once if it came to us. But in some situations, and there is examples of it in the past where a royalty burden is quite high, and an operator will come to you and be like, "Look, man, we're struggling. Your 5 or 10% royalties killing us," and you might work out a deal in that sense. But operators typically will try and buy back royalties that they don't own, but once it's in a royalty company's hands, it's pretty hard to get it back. We love our royalties. We're not in the business of selling them back to operators very much.
Mm-hmm. Sometimes it is buyable. So sometimes it's in the contract, right, where they can buy like half of it.
They can buy it down. Yeah, for sure. And look, there's instances where we've given buyback rights in some of my previous iterations, nothing to do with Summit, where I'm like, man, if they buy this thing back, we made a good investment, or buy back half of it, or typically you don't see an entire buyback on these things. But the one thing that, creates some confusion or some creativity with the royalty market is all of these contracts are different and they can be tailored and very unique in different ways. So it's like a snowflake, to be corny. Every snowflake is different.
What is it for you with Madsen? How much money would they have to pay you? What can they buy back?
They can't buy back anything.
Nothing.
But no, they don't. They have no rights. But look, if Shane and the team called me up and said, "You bought this for 8 million, and do you want 50 for it?" I'm just throwing out a silly number. I think we'd be open to listening to that. But everything's for sale. Everything's got a price. I mean, the companies, the shares, everything. I'm not inviting West Red Lake to try and bid me for the royalty, but there's an opportunity there. And look, and sometimes things need to be restructured. You saw it famously with Alexco with
That's right.
When they sold to Hecla, they renegotiated them. Wheaton Precious. We don't have anything that's a truly significant economic burden on any of these mines. I don't suspect that this conversation will happen, but you never know.
Bomboré in Burkina Faso is also a big part of the story for you, at least for now. I believe it's about a third of the expected revenue next year. And it's, of course, the first thing that comes to mind there is your potential political risk or nationalization or whatever else is going on in those parts of West Africa. How do you see that risk?
On a risk-adjusted basis, fantastic. And I'll explain to you why. The largest shareholder of Orezone is, I'm going to blank on the name, is a private equity firm. The chairman of that runs the bank that's lent them a lot of the money. So there's very good economic and political alignment at that asset. Cupris is the name of the bank that's lent them the money to do all this expansion. The other side of it is it's south of Ouagadougou. It's not had a lot of security issues in the past, and it's been operating quite well. There are stories and there are machinations of much tougher parts of West Africa in general to operate in. Again, I don't pretend to be, a guy from Canada here pretending to be experts on it. But from a risk-adjusted standpoint, if you look at the return we're generating and what we paid for it, it's a slam dunk. We're quite comfortable there. I think they're putting close to $200 million in the next year and a half into this asset. So management is obviously quite comfortable as well.
Mm-hmm. So what does the production profile there have to look like? And again, realized metals prices and whatnot for you, for you to get the money that you're hoping you're going to get, because again, it's a silver stream that we're talking about here. So it's not an NSR, right? It's a 50% silver stream. Correct. So a bit different than an NSR. What has to go right in order for you to get that payout?
Well, quite frankly, and we'll talk about it in a second, the silver receivable pays us back. They're going from 120 to 250,000 ounces by the end of 2027 on a run rate. This was an oxide deposit. They're now building a hard rock deposit for the sulfides. They're commissioning it next month. They're going from 120 last year to 170,000 run rate next year. Mm-hmm. Then they're doing a second expansion to go to 5.5 million tons by the end of 2027, at which case their guidance, again, this goes back to my conversation earlier, but this is all based on what guidance and the operators are saying. It's going to be 230 to 250,000 ounces. Our thesis is very simple. More gold equals more silver. This is verified by our technical due diligence. It's based on the relationship we've recognized within the ore body the whole way through. And that relationship is, let's just use simple numbers. For every ounce of gold, there's 0.25 ounces of silver, and that will continue for a long time. There's also minimums in there, and that's where a silver receivable comes from.
Mm-hmm. Orezone does have the right to buy back half of that silver stream, if I'm not mistaken, though.
Correct. So if they execute and build this plant by the end of 2027, which they are threatening to do, I certainly, they haven't announced a formal second expansion. They can buy back half of our stream. So we'll be left with a 25% silver stream for 7.15 million US. That's multiples of what our carrying value is on it. We actually don't put that in our models because it seems subjective, and it also seems like you're making it too good to be true. But yeah, they do have a buyback right and they have to execute it by 2027. That's 5 years after the creation of the stream. That's actually, we talked about buybacks earlier. That's the only one that really of consequence economically within our portfolio. But if they're buying that back, I'm taking that check with a smile on my face.
So essentially, they can buy back half of the half for half of your stream, but so that's half of the silver that comes from there for 7 million. What would you replace it, or is that enough money to replace that 25% with?
Well, I imagine if they're buying it back, it's worth more than the 7 million. So I would imagine not. Assuming you're dealing with a rational actor here. If they're buying it back for 7, they think it's worth 10, or they think it's worth more than 7. Mm-hmm. But that number, I mean, the original contract put in place was 7.15 million for that 50%. So that's all of the money coming back, along with 70,000 silver ounces at no cost to us. Along with, that would be 20 to 25,000 ounces of silver a year versus 40 to 50. We still have a viable economic interest there. Maybe that's a scenario where silver is at $150 or something wild like that, and they just have to.
Is that something you've talked to them about? Have you talked to them about this?
They're acutely aware of it. I don't like to remind them that they can cut us in half. So, and I think that's a conversation that may come up later on down the road. Also, in the instance, it's not triggered by time. It's triggered by time and executing a 5.5 million ton per day plant, ton per annum plant. And if they don't hit that number, they can't exercise it anyway. Mm-hmm. It's a stretch goal for them, but you're rightfully highlighting something that 100% exists as a contract between us and Orezone.
How often do you get to talk to them or any of the other operators on your royalties? Like, is there an obligation for them to give you quarterly updates or monthly, or do you just, pick up the phone on a Sunday at 6 a.m.? How do you talk to them?
So specifically, we do have information rights with some of our royalties and some we don't. But let me just talk philosophically, because I actually had a call today. Actually, I'll share it. It was with Denarius. Because we are out actively marketing, they see this as an extension of their sort of messaging. We do try to make sure that we're on the same side and the same messaging with all of our operators. So we speak to them quite often. Some of them are reluctantly, oh man, you got that royalty, we were hoping to buy it back. But then they realize that there is a benefit to partnering with a group like ours that is out marketing and telling the story, probably to investors that they don't talk to. So we talk to them quite often. We try to have that communication as open as possible. And this has been consistent with every royalty business I've ever been involved in. It's better to have a healthy, happy dialogue when you can't. Not every operator is going to love you. I've worked with majors that give you as little information as they legally can, and then I get other ones that invite you to site. It really depends on just like people, companies can be adversarial or friendly.
Let's talk about Colombia. You're mentioning areas there, Zancudo, 0.5% NSR in Colombia, operated by Denarius, and it's actually already in production. They're mining and shipping ore. Their own guidance points towards ramping up to 1,000 TPD in 2026. Similar question. What are the assumptions that you're making there as to how much of that will hit your treasury?
So this one we can't do formal guidance on. Well, we don't do formal guidance on any of this. We're very confident where Denarius will be in 2027. The ramp up and the timing of things has been a bit of a question mark, and there's been some delays related to permits and other aspects of it. They have the installation license for a 1,000 ton per day plant. It's on site. They've got to put it in place. They're doing a lot of development work at the mine. I think they're doing a kilometer ramp at the Independencia mine. I should have checked my notes before this question, but bear with me. But the technical report calls for 60 to 80,000 ounces for 10 years, gold equivalent. And that, using today's prices translates to about $1 million. We think in 2027, they'll hit it. In fact, I would suggest if you annualize the third or fourth quarter of 26, we're probably going to be hitting close to that number. So we're very confident in their ability to get this up and running. The timing is a bit of a question mark. That timing is getting a little tighter as they get their permits and raise a little bit more capital. Quick reminder on this one. These are the same guys that built and operate Segovia. It's the largest gold mine in Colombia. It's the exact same team. It's the same CFO. It's the same CEO running it. So we have high confidence in the team, and operating in Colombia is something Serafino and his team have done in the past. They've got the permits in place now. So that's coming with time.
How do you see their community risk in Colombia and just jurisdictional risk in general?
I would suggest the perception is it's heightened. These guys are operating within a local community and in a place where they have operated in the past. Serafino is extremely connected down in Colombia. I'm not suggesting he's got an upper hand, but if I were to bet on a team in Colombia, it would be them or Aris Mining or some of the guys that are actively operating there. As a reminder, this is the team that created the company that most of the assets that are in Aris today were put in production or put in place by Serafino and his guys. So they've operated there for well over a decade and know what they're doing. The political risk, I'd say because it's closer to a community, is probably a little bit less from the nefarious sort of FARC conversation, but we're quite confident there that they can get it done. And again, in the context of what we paid for this asset or Bomboré or any of these for this matter on a risk-adjusted basis, we're very comfortable.
Mm. Permits and everything else is in check though for them. Politically, they're happy and community and everybody there happy and healthy. Essentially, they can actually mine and deliver, or do they still?
They're mining right now. They're mining right now. Yeah. Okay. I haven't been there personally, but there's a nearby town that where a lot of the local workforce comes from.
Right. I know you almost have to run here, Drew, so I'll work toward wrapping it up. Again, this is kind of an introduction conversation. I'm sure I'm forgetting a bunch of stuff to ask you here in the meantime, and I'm sure people listening and watching, they'll remind me of it, and hopefully I can get you back on in the future and talk about that. You said G&A wasn't all that much, but if you're looking to grow the company, you might be looking to grow the team or not. So yeah, talk to me about G&A. How much are you budgeting for G&A this year or next year?
I mean, the salaries between Connor and myself is less than $500,000 Canadian, and we're definitely working for every penny we get. From a team perspective, we've got a part-time CFO. We potentially might be bringing a consultant to help on the IR side, but I'd prefer to keep it lean and tight where we can. Have a very small team of very competent people that are paid properly than have a bloated team and this isn't a shot at anyone else, but that's the philosophy of the business right now. And as an extension of that, I'd also add, I don't want to hire people because I think I'm going to be busy. I don't want to hire people because I think we're going to have a problem. When I'm inundated or I'm spending too much time on certain parts of the business where my time is better served for investors to be in one aspect or another, we will bring in people to help out along the way. But a tight G&A and a cash flowing business is what we got to deliver.
Mm-hmm. So what does a tight G&A look like? How much is that for you?
Well, let's see. Between Connor and I, it's like I said, it's under $500,000 Canadian currently. There will be some new contracts in the new year. They're not going to be egregious or they'll be below market rate. But that remains to be seen. And I think we touched on earlier what the KPIs are. We're sort of formalizing all of that as it is. Mike, I was more or less a founder and consultant and put a contract in when we first got the IM Gold stuff done, and Connor didn't join until June. So my CFO came on in August. I mean, to say this team, I can't sort of stress what a nascent stage this company is at right now.
Yeah. What are you going to do for marketing? How much money are you looking to spend on marketing? Because you said that part of, solving that valuation gap there will be marketing. How much do you want to spend on doing that?
Again, we don't have a firm number on that at all. In fact, that's one of the things that we're currently working through. It won't be, over $1 million or a wild amount. We want to market in a sustainable way, and that includes sort of shying away from some of the frothier, I don't want to say pump and dump, but things that really throw oxygen into a stock, and then when they come off, they collapse. We want to do this in a sustainable, ethical, and transparent way. So that's unfortunately not something I have a quick answer for.
Hmm. But so what are you thinking in that case? Is it like mostly conferences, or are you going to be doing digital? Anything special that you're planning there? Yeah, what do you want to
We've
do
got a
there?
digital. We did some digital marketing. Actually, we did a corporate video that we're uploading right now with the team at Market One that have been fantastic. We've signed up for a couple conferences with the CEM guys. I think we're going to go. I always go to VRIC. I don't go as an attendee. I go there because there's a lot of people in the conference. So conferences are part of the budget. Digital marketing is part of the budget, but we're really focusing on the retail, the marginal retail buyer, and the institutions are coming through sort of our investment banking relationships on the street. The strategy, it needs to be firmed up. The attitude and the philosophy is we need to market and do it often, but not, go to every single conference and sign up every single newsletter writer and stuff of that nature.
Yeah, I agree. It makes me laugh when you say because a lot of companies still do that kind of thing. What's the most fair criticism of Summit that you've heard so far, Drew?
What do people hate about you? Too small. Would probably be one of the things. I think there's perceptions of the company that I can dispel pretty quickly. So the too small comment, we're too small, watch us keep growing. Liquidity was a concern from a lot of our shareholders. The volumes are quite heavy for a very new company that has done literally next to no marketing. So I can be proud of sort of where we're blocking. And I'd say one of the common questions is, aren't you just going to get acquired? Are you're not going to get to keep it? And then I kind of look back at them and go, is that a bad thing if we get taken out at a premium? Is that not a liquidity event for everyone? Anyway, I'm not suggesting we're not selling the company anytime soon or trying to sell the company anytime soon, but that's part of it as well. And then I guess the last one would be, how are you going to compete? And watch us compete. We've done it already, and we'll keep doing it.
What's your most fair criticism of me? What do you wish I would have asked or brought up that I've failed to bring up?
I expect, well, you're doing a great job, Antonio. Let me just tell you that. I would have expected more conversations around where you see the royalty market in relation to buying a producer, buying the GLD, buying the GDX, stuff like that. But I think that's probably pretty well documented. And I guess, maybe we didn't talk about the team enough, but that remains something we can visit next time I come back.
Yeah. Maybe next time you come back with someone else, and we do talk about the team. We get to meet a couple of the guys and gals running the show behind the screens. But no, it's been a pleasure. I'm looking forward to our future conversation again. If people watching or listening think or have interesting questions for our next conversation, please let me know what it is, and then I'll make sure to ask them next time. But yeah, Drew, I appreciate your time. Thank you so much for doing this.
Real pleasure. Thanks a lot for you and your listeners.
And as always, thanks to everyone for watching Resource Talks. I have a couple of more things to say, though. The fact that this company was interviewed here today does not mean that they're necessarily a good or a bad company. I'm not here to endorse nor attack anyone. I am simply here to ask some questions. If you find that I have failed in asking a question that you would have liked to hear an answer to, which will happen as I'm not an experienced interviewer, please let me know, and I will try to correct that mistake in a future interview. As mentioned at the beginning, please understand that mineral exploration and development is an extremely risky business. Losing money is the norm and should be the expectation. This is a very complex sector, and the performance of individual companies typically depends on many different moving particles, including company-specific factors like geology, financing ability, and many others, really, as well as particles that are outside of the company's control, like geopolitics, macroeconomics, commodity prices, and many more, most of which are nearly impossible to fully understand. Moreover, these companies that typically get interviewed on Resource Talks are in the pre-revenue stage. which means they rely on the public markets for the financing of their operations, which could result in shareholder dilution. Furthermore, as a general rule of thumb, you'll be better off understanding that all company communications online, albeit this interview or their website and their presentation and their social media accounts, or even the social media accounts which you thought were your friends and then told you about a stock, everything really that these companies do is intended as marketing. And although I do not make buy or sell recommendations because there is a clear conflict of interest given the nature of my business, many out there do. And you should be aware of that inherent bias, and you should be careful out there. That bias is not always going to be clearly disclosed with everyone out there. So it is safer for you anytime you're watching any type of company-specific content to approach it with a dose of skepticism and assume that the party telling you about it is biased in at least some shape or form, because there will always be a bias, again, albeit clear or not. So always ask yourself what the incentive of your counterparty is and never rely on them regardless of their incentives, but instead double check if what they're saying is true, again, by using setterplus.ca. The fact that I have no idea what I'm doing should already be clear to you at this point. I am not saying this to make jokes or laugh with myself. I just simply do not have a long enough track record of consistent investment profits. So I should under no circumstances be considered an authority on anything. Again, although this may sound amusing to you, believe me, it is not amusing, and it is not intended as a joke. I'm simply pointing out a fact and warning you not to rely on anything I do or say. Unfortunately, at least to my understanding, nobody out there has any special abilities. The CEOs do not possess any superior knowledge, and they cannot know about what will go up, what will go down, or what will go in circles. Some people even believe that to be rule number one on Wall Street. Nobody really knows. None of us know whether any of the company's activities will result in a success, again, given that we're talking about high-risk activities where most of the times it ends in failure. So unfortunately, try as I may, I won't always catch all red flags or all challenges with the companies. So even if I did ask a few tough questions in here, don't rely on this being all of the tough questions. Again, these are complicated startups with many moving parts, and I am conflicted given the nature of this business. Therefore, I cannot guarantee the quality of anything presented in this video, and you cannot hold me responsible for any losses or damages stemming from the way you decide to use this interview. Viewers, listeners, and readers acknowledge and agree that the information presented herein did not constitute a solicitation or an offer to buy or sell any security or investment or to participate in any trading strategy. Resource Talks and all parties involved in the management of the business strictly disclaim any and all liability for losses and or damages, whether direct, indirect, special, or consequential, or other consequences, however so caused, arising out of any use or reproduction of the content published by Resource Talks or any decision made or action taken in reliance upon it. By consuming this content, all consumers vow to release Resource Talks and all parties involved in the management of the business from all claims, proceedings, or consequences. This is all to say, I know it's a lot of lawyer talk, but this is all to say that you shouldn't blindly trust me or anybody on the internet, and you should do your own research. Once again, social media is meant for entertainment. It is setterplus.ca where you do your research. That's where you'll find the company's official filings, and I encourage you to read and analyze the Management Information Circular, the financial statements, the Management Discussion and Analysis, and whenever available, the NI 43-101 technical documents. If you don't understand everything in those documents, the chances of you losing money are even higher than they normally are in this space. And as mentioned earlier, the chances of even the best analysts in this sector losing money are extremely high, since this is venture capital and it is not for everybody. I'll leave you with one of Charlie Munger's quotes, which I wish I had listened to more often earlier on, which says, quote, "If you don't understand it, don't do it."